Hello and welcome to Macros with Mythili, our weekly half-hour program where we take a close, dispassionate look at all the major macroeconomic developments and the week just gone by. Well, in the week immediately after the budget, what else can the Macros discussion be about, except about dissecting the fine print of the budget? And to do that, we're joined by the two most eminent economists that one can possibly think of. We have Jahangir Aziz from JP Morgan and Chetan Ahya from Morgan Stanley. Welcome to the show, gentlemen. Chetan, if I can start with you. After now, everything's over bar the shouting. But once you look at the fine print over the weekend, what is it that kind of excites you in Mr. Jaitley's speech and his budget at a glance and other documents? And what is it that really disappoints you once you go through the fine print?
Well, I think the big picture message is that they still want to try and revive the capex cycle, and they want to be constrained in not doing too much redistribution. And now that's the challenge which India has had in the last 5 years. As you know, that redistribution was the big focus and nobody cared about capex from the policy perspective. But we've now seen a decided attempt from these policymakers to try and revive capex. And in that context, I was pleased that they have earmarked the revenue from excise on petrol and diesel towards that infra spending, and totally the investment push from the government side, either public capex, is about close to 1% of GDP. That's, I think, the positive part. And the issue when you said that, what was not exciting was the fact that, I thought that they would have probably at least tried and still stuck to that 3.6% deficit number. Instead of that, they have targeted 3.9%, which is not too bad considering the fact that there were issues about the Finance Commission recommendation to be implemented. But I think India's fiscal deficit is still too high at a national level at 6.5% of GDP. We would have loved to see that consolidation happen a little bit faster than what they have taken up.
Jahangir, do you concur with that view that a 3.6 slippage to 3.9 is actually not a very good thing? Or do you think it was necessary at this particular juncture, particularly because neither 3.6 nor 4.1 would have been an honest number, to be very honest?
I would actually go a step forward on Chetan's argument. So let me just look at the numbers that we had. So last year, when the government delivered its budget, it said it was going to bring down the fiscal deficit from 4.1 to 3.6%, a half a percentage point of consolidation effort from the part of the government. That was not conditional on oil prices doing anything. Or any other global variables turning in from headwinds into tailwinds. So if you believe that the government was supposed to do that effort, so the starting point is 3.6% of GDP. In addition to that, you've got about a 0.6, 0.7% of windfall gain coming from lower oil prices. And that means that the starting point in the budget should have been 3% of GDP. You could have then argued that should I pass on the entire 0.6, 0.7% of savings from oil to reducing deficit, or should I pass on part of that to infrastructure spending to support the economy? So somewhere between 3.6 and 3 would have meant that the government has made the effort of fiscal consolidation of half a percentage point and has split the windfall gain between further fiscal consolidation and has supported the economy. Instead, as Chetan pointed out, they went for 3.9%. So essentially, there has been almost no effort in consolidating. In addition to that, we have this fiscal stimulus coming in, which at this point in time, there isn't really any macro reason to provide the economy with any stimulus. None of the global headwinds that we had over the last 2 years, I mean, all of them have turned into tailwinds. Developed markets are growing faster. Oil is going to be lower. Global financial conditions are going to be easier. So really, in sense of, what is the macroeconomic justification, really can't find that.
But Jahangir, what exactly would you describe as a fiscal stimulus at this moment? In fact, the argument really is that excessive fiscal austerity at a time when the private sector is not kind of doing any investment would be a wrong thing to do. So what is the fiscal stimulus that you're seeing really? Is it the boost in public investment?
Let's take growth. I mean, we really haven't, controversies about where the growth rate is. But let's take 7.5%. 7.5% growth rate going towards 8%, and you want to stimulate that economy. Let's take the case that the corporate investment isn't picking up. But if you want to, but if you look at the binding constraints to corporate investment, not a single of those binding constraints, environmental laws, the land acquisition, the poor risk sharing in PPP projects, and the constraint in terms of high leverage of investment of infrastructure companies, none of this includes, greater public investment. So if you really wanted to get corporate investment going, you could have taken the same amount of increase in capital expenditure and said, look, I'm going to actually do two things. I'm going to actually increase my share in the stalled PPP projects that would get corporate investment going. And the other part, I would go and increase the bank recapitalization so that the bank credit flows could be going. That I would understand. In other words, instead of actually saying that, look, I'm going to start building additional roads or additional bridges, I'm simply going to write checks, because in the last 15 years, I have never really managed to go beyond 1 percentage point of capital spending.
Chetan, would you agree with that assessment that the government seems to be giving a fiscal stimulus at a time when, if you go by CSO data, the economy might be seen as close to overheating? Which brings me to my second question. Is the economy close to overheating? Do you buy the CSO numbers? Is 8%, a recovering economy, or economy which is already recovered?
I think, we should not talk about growth number. That will need one full 1 hour show on that. I think we've concluded, in fact, the economic survey has also concluded those numbers in terms of the magnitude of growth acceleration that it shows is definitely questionable. And so I would not get into the debate of whether the numbers are right. But clearly, if you look at the industrial production, if you look at the corporate sector sales growth, corporate sector profitability, economy is in a weak shape. But I think at the same time, the way India's economy has worked is that you get this control on inflation, you ensure that interest rates come down, and over period, as government continues to do the right thing on the policy front, you get a revival in capex. I agree with Jahangir to the extent to which it is not in a state where even while growth is weak underlying, you need to run such a high level of fiscal deficit. So I think, more than delta in fiscal deficit in terms of it going up or stimulus from that perspective, Mythili, what you should see is that the total deficit, if it is at a country level 6.5%, it is quite high and therefore expansionary. And this is in fact the key reason why India's inflation had been so high structurally for those many years. So we got to live with some weakness in growth, be patient. These guys have 5 years. There is no hurry to stimulate the economy by running high deficit. But look, I think on a big picture basis, my idea is not to get to a stage where we end up giving a message to the viewers that we are bearish on India or that, this is a big issue. It would have been nice to have it lower, but if it's not necessarily changing our view that economic cycle is going to turn. Not because of just fiscal deficit, but a whole lot of other things which the government is doing right.
I'm afraid I'll have to interrupt you there because we just slip into a very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the fine print of the budget with two of the most eminent economists, Jahangir, Aziz and Chetan Ahya. Jahangir, there's so much emphasis on the fiscal deficit as a number, but what would worry me more than the number per se is the quality. And there I agree with you that in fact the revenue deficit as a percentage of the fiscal deficit, it's become worse. So that worries me. But the fixation on fiscal deficit, I think the fear is that rating agencies will downgrade us. Now, I've actually managed to put together a table of rating agencies and how the rating has changed from the year 2000, and the rating very obviously seems to be not driven by economics but quite often by politics, because there have been times when they have downgraded us when our fiscal deficit position has improved. There have been times when they've upgraded us in terms of the outlook when actually our fiscal deficit situation has deteriorated. So are we being excessively fixated on fiscal deficit, and should we worry more about revenue deficit, where I would agree with you, yes, there is reason for worry. So what should we be looking at, the fiscal deficit or the revenue deficit?
So let's look at the question in two different ways. So let me just respond to the question about what Chetan raised. And Chetan raised a very valid point. We should not be looking at 7.5% or 8%. We should be looking at the direction of high frequency indicators, and none of them point to any real massive growth taking place close to 7.5%, 8%. But if we buy that argument that growth is not really at 7 or 8.5%, then you can't really even buy the argument that nominal GDP growth that has been assumed in the budget is 11.5%. So nominal GDP growth in reality is much lower than 11.5% of GDP, which means that the tax revenue buoyancy that has been assumed in the budget is extremely high. So I think we can't have it both ways. So if we are going to buy the story that really growth is at 5.5%, then we also have to bring down the nominal GDP growth assumption in the budget, which they haven't done. But going back to the question that you raised about fiscal deficit, I think we should need to worry about fiscal deficit not because rating agency will downgrade us or not. We should be worried about fiscal deficit simply because whether or not the government should be providing additional stimulus to aggregate demand at this point in time. Look, I mean, the budget to me almost looked like two different parts stapled together. It was extremely strong on institutional reforms. I think just on institutional reforms, it is probably one of the best budgets we've seen. But if you look at the institutional reforms, let's take the first one that everybody's talking about, that RBI will now formally be asked to do inflation targeting. It will be somewhere between 4 and 6%. The FM said below 6%. But suppose we really want the RBI to get to a 6% inflation target. Should we be pushing the economy by doing things on the fiscal policy front that isn't really going to help the Reserve Bank of India to get to the target? If you look at pump prices, they are going up. If you look at indirect taxes, they're all going up. So I really do not understand the consistency between the institutional reforms, which are extremely good, extremely well laid out, and the near-term fiscal policy stance that the government is adopting.
Chetan, would you agree that yes, there are some queries that one can raise as far as the gross tax revenue, the budget arithmetic, the assumptions underlying those the numbers, they seem very suspect. But the government's argument is that if the economy grows at 11.4%, 11.5% as assumed, which is the same as last year's, the nominal rate of growth, the tax buoyancy is about 1.3%. And we have seen tax buoyancy like that in the past. So it's not completely unrealistic, and particularly because the hike in service tax, we should be able to get those kind of gross tax revenue numbers. Would you agree with that assessment, that it's not overly optimistic?
Yeah, I think the tax revenue estimate is realistic. Actually, we can for a moment just ignore the nominal GDP growth, but work around the math of increase in excise duty on petrol and diesel, and at the same time the increase in service tax. Those two together should be able to give them that number of 15.8% growth that they have assumed. So, look, I think if you adjust for that, the implied tax revenue growth just for the economic recovery is not really built in quite a lot. So yeah, it's quite realistic. So I'm not really faulting with the tax revenue growth number.
And what about on the expenditure side? Are you a little surprised that the subsidies haven't come down? Despite all the talk about food subsidies coming down, it's higher than before. So too fertilizer subsidies. And as far as petroleum subsidies are concerned, they seem to have been very conservative because you're assuming oil prices will stay soft, and there's no saying where oil prices will go. It's a very volatile commodity.
Well, in fact, again, I think on the expenditure side, there is a problem for the overall number because they have shifted some responsibility to the local governments, i.e. state governments. And so the expenditure growth is quite small. And it's very hard to then conclude exactly what's happened. But we did a backward math, and our math shows that on a like-to-like basis, the expenditure growth was 14% in the assumption, which is still quite high. But I'm sort of the view that if they do not get that tax revenue number or the divestment receipts are lower, they will curtail expenditure growth. So I'm not going to still conclude that they will slip, and I'll doubt on their determination to show 3.9% because that's what they have already done in the first 9 months of data that we have for the current financial year. So, look, I think broadly, I'm less skeptical about the numbers which they have represented to us, but just that, yeah, I would have liked that deficit number to be lower. On the question on subsidy, in fact, the 300 billion rupees that they have assumed, when I discussed that with our oils team, actually they are pleasantly surprised because of the way the current oil price is, and of course they've done the fuel price hike on the weekend itself. They actually don't need to show even 300 billion rupees if they go on with the past sharing mechanism with the oil companies on subsidy. In fact, 300 billion rupees implies that they're going to take a lot more on themselves rather than put it on the oil companies, Probably they are doing that because they want to do the issuance of those companies in the market. But as such, the oil subsidy number also looks fine to us. And yeah, the other subsidy numbers are going. In fact, food subsidy is flat as a percentage of GDP, and in fact, it's gone up last year. And I think they have mentioned that they will try to reduce it with the implementation of the direct benefits transfer scheme. So it wouldn't have shown up immediately in the current financial year, and that's why that number is still somewhat high. But I think the real effect on that front will come in the year after. So, Mythili, almost I'm looking like representative of government when I'm trying to answer these questions to you.
I know.
I cannot buy these points.
Yeah, Jahangir, I was just going to say that I think Chetan is far more generous to the government than I've been really so far. But what about you, Jahangir? Do you buy the government? I'm not going to ask you on tax revenue. We'll let Chetan, kind of be the government spokesman, quote unquote, as it were. But what about disinvestment? Do you believe that 69,500 number? I mean, you haven't even achieved half that number the previous year, and we've seen it year after year. And yet you have the government give you these wonderful numbers, and we're all supposed to believe it. Do you believe it? I don't.
Look, I mean, just before we go to the disinvestment number, look, I mean, I agree with Chetan. Look, that if the government does not get the revenue, they are not going to spend. But isn't that what we've been doing for the last 4 years? So where is this high quality of fiscal adjustment that we were hoping for, that this government would be different? This government will then be doing exactly what they did last year and what the previous government did for the last 3 years. So in a sense that, if you're going to if you're not going to create any space in the budget to take into account revenue shortfalls and yet continue with the expenditure, you haven't really done expenditure management. But coming back to your point, I mean, look, I mean, it is clearly possible to reach this disinvestment target if you are going to sell your SUTI shares and shares that do not require, massive amount of work to be done. So as long as you do that, I don't really think that a 65,000 or the 69,000 crore number is really a problem to deliver. But my guess, going back to what you were saying, that you haven't really managed to even get half of that in previous years, simply increases the uncertainties. And then I'm going to go back to my earlier point, which is that, look, if you miss disinvestment with 30,000 crores, what are you going to do? You're going to cut down capital expenditure by 30,000 crores, and that's not really what a good budget framework should be doing.
Absolutely. In fact, we've all been talking about SUTI until we are blue in the face. But were you a little surprised to see that all Dr. Bimal Jalan's work seems to have gone in vain? He submitted an interim report, but I saw no sign of it. Did you see any sign of it in terms of expenditure, Jahangir, in terms of expenditure cuts? Is there any rationalization that you can think of?
Look, I mean, I think the government is unlikely to actually change the parameters of the subsidy program. They're probably going to use more of the, the various, cash transfer elements, etc., to reduce the overall size. Now that, of course, reduces the overall subsidy bill. It doesn't add very much to economic efficiency. The homemaker will still have to buy the additional 2 cylinders of LPG to get the cash transfer. The farmer has to buy the 2 additional sacks of fertilizer to get the subsidy. So it doesn't really reduce the resource use or optimize the resource use, but it really reduces the overall subsidy bill. But I think what the government should be praised, and I think this is a part that we haven't really addressed, is the fact that for the first time the government is talking about a universal social security scheme covering all 3 different kinds of insurance. It's a beginning, but I think clearly there are elements in the budget, as we were talking about, which from a medium-term standpoint are really standout propositions. And that should help the medium-term growth prospect of this country.
I'm afraid I'll have to interrupt you there because we just slip into a very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the fine print of the budget with 2 of the most eminent economists, Jahangir, Aziz and Chetan Ahya. Chetan, you can put me down as a completely skeptical, cynical journalist, but were you enthused really by that National Investment and Infrastructure Fund for which the government has set aside some money of 20,000 crores?
Well, I think it's a good step in the right direction. I mean, it's just a question of getting the funding sorted out in case the public sector banks are risk averse and they don't have the funding. the government probably doesn't want that funding side to be completely unaddressed. So I think it's an interim step. I don't think that's really the long-term solution. The long-term solution is to get that system on its own capable to deliver for projects, because this fund does not have the ability to do any credit risk assessment. It is just an intermediary fund, which in turn is going to fund either IRFC or NHB. So I think it's a good step, but it's not really like a big deal that really changes the whole infrastructure financing space.
Okay. Jahangir, what do you think are the biggest really takeaways from this budget? Is it the reduction in the corporate tax, a roadmap for which he's announced, or is it the huge, I would call, concessions? I don't know whether they'll agree with me. As far as FII investors are concerned, there have been a huge amount of changes in terms of emerging FDI and FII, in terms of MAT for FII, permanent establishment. So which do you think is really the big change item that in this budget? Jahangir.
Look, among the things that you talked about, I think clearly the FI, FDI separate. I mean, we're no longer separating the two of them. That will clearly get at least bank stocks up quite a bit, and quite a bit of tailwind to bank stocks, which is probably what we're seeing in the market at this point in time. I think the corporate tax is a bit more unclear. Effective corporate tax right now is 22%, which includes the MAT of 18% on all the exemptions. If we are truly going to move to a 25% corporate tax rate without any exemptions, and I'm taking the government's word for it, then essentially we are moving an effective tax rate from 22% to 25%. I don't really see that as any real benefit over the next 5 years' time. It is good for the budget, but for the corporate sector, not really sure. I would say that the real big benefits that's come out of the budget is the promise of a bankruptcy law. It's a promise of a dispute resolution mechanism. It is a promise of formalizing inflation targeting, and the fact that the government has moved towards greater devolution of funds to states, which are untied to central government mandates. I think those are clearly huge moves, and those are the positives. And as I spoke about a few minutes back, I think the universal social safety net, the move towards that, I think these are really the key, to me, the three big positives taking from the budget.
And Chetan, would you concur that the really big positive is the merger of the FDI and FII and the social security, etc., bankruptcy law, though it's been talked about in the past? Would you agree, Chetan, with Jahangir's assessment?
Yeah, I broadly agree with his assessment, but I think I would sort of club it to say that, okay, they're trying to revive the investment cycle, and all these steps, institutional or otherwise, effectively work towards change the sentiment towards the business cycle. So I think broadly that has been done right. And I also at the same breath always tell our investors as well that, look, I think this is just a small thing in the overall big picture story of India. Budget is never a game changer, and therefore we come with that expectation when we are looking at the budget. And what we really need to now look is the four legislations which are pending in the Parliament: the Land Acquisition Bill, GST, Coal Mining Act, and the FDI and Insurance Bill. So I think that is what is our bigger focus. I think each of those legislations are more important than by itself the budget is. And then what is RBI going to do, and that the monetary easing support that we're going to get after this. Those are the two important things to watch in terms of the overall growth story, rather than just trying to think, how much can the budget really do.
Absolutely. The budget alone can never be a game changer. There's much more at stake in this country. But both of you are much more optimistic than I am, and I do sincerely hope that I'm proved wrong and both of you are proved right, because we desperately need you and the government to be proved right, at least as far as the budget and everything else going forward is concerned. Thank you so much, Jahangir, as well as Chetan, for joining me in this discussion. Thank you very much.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.